the game plan is we have to learn two things. So first, we're going to learn options. We're going to go a bit more granular, start with basics, but slowly increase our level of understanding. If things go nice, maybe we will also play an exciting quiz type of a game today, where I will give you some assignments and you try to do them. And once we're through with options, then we will also work on another type of product called swaps, where I'll give you a nice introduction of how do you want to look at swaps. This will take about 90 minutes for me. And in the final 30 minutes, I would be answering your queries. Now, throughout the session, if you feel that there is something that's not making sense or there is something that you're not comfortable with, then there are three ways in which you can resolve the query. If you're attending this on YouTube, just put this in the chat box or put it in the comments later on. If you're attending with me live on the Zoom panel, then either you can put your queries on the chat box, or you can simply raise your hand and then I will enable your audio. You'll be able to ask me questions. Okay, so with this background, let us get started. Now, what we know with options is that options are a symmetric contract, which means that the payoff is kind of skewed towards one of the two parties. So within options, there are two types. Within options, there are two types. Can you guys help me recall which are the two types of options? There are two types of options, right? Which ones? Yeah, so two categories of options. So we'll say either an option could be a call option, typically in plain vanilla products, or we're looking at put options. Now, within each type of option, you can take three types of position. Tell me which are the three positions that you can possibly take on the call option. You can take either a long position, or you can take short position, or you can take which is the third one. Okay, there's just two. So either you're on the long side or you're on the short side. Same story here. Either you're on the long side or you're on the short side, right? So technically, if you're playing on options, if you're trading on options, if you're hedging on options, if you're speculating on options, you're either on the long call, short call, long put, short put. So four of the possible positions that you can build. Now, can I say that a long call means buyer of the option? Do you think that's an appropriate word to use? A long call is buyer of an option. Yeah. So let's call this guy as someone who is a buyer of option, a buyer of call option. So if you are buying the call option, then who is selling it to you? If, for example, if you're paying money and buying the call option, there has to be someone selling it to you. So who is selling it to you? So it is the short call. So this guy is the seller of the call option. So seller of the option. Now, seller is also called with different words. So at times, instead of seller, we might use the word. Does anyone know? Correct. Writer with a W. Writer with a W. We'll say that this guy is writing the option, or he's writer of the call option. So when you're selling the option, you can call yourself as short call, seller of the option, or writer of the option. So we have these three choices. Would we call ourselves lender of the option? No. So it doesn't work that way in case of option world. Stock is a different business, right? But this is options. So here we have a process of writing. So probably in one of the slightly advanced classes, I would be discussing a concept called open interest. So in open interest, we'll understand why we don't use the word lender. Okay, now how about long put? Is long put a buyer or a seller? It's a trick question, so be careful. Is a long put buyer or a seller? Long put is buyer. He's a buyer of the option. Buyer of the option, right? So this is what causes people a lot of confusion, that how come long put is a buyer. So here's what you want to know, that if you're on the long side, you're always a buyer. Now in this case, buyer of what? Buyer of the derivative, buyer of the put option. So you're going to pay money and you're going to buy the option, and that option will give you a right to sell something. So there is going to be a right to sell, but since you're paying the money and buying that right, therefore you're buyer of the put option. And short, as usual, we will call this guy as either seller, or we will call this guy as the writer of the option. So that should work pretty well. Now, this buyer of the call option, does this guy pay premium? Does it pay to the other party, or he receives from the other party? What do you guys think? Is he a payer or receiver? Payer. So we'll say that this guy will pay premium. Okay, now some of you with background in options, the first 5-10 minutes you're going to find too basic, but hold on for it, because after that I'm going to do a rapid fire Q&A session with you, and you'd find at that time you'd find this flowchart super helpful. So pay premium. How about short call? Will you pay premium or receive premium? Short call, receive premium. So a short call is in the business so that he can earn the premium, and a long call is in the business. So he's in the business because he can get the right. Same story applies to long put. Long put will pay premium, and short put will receive premium. So have I made a mistake, Hemant? Does it look wrong, or is this correct? What do you guys think? Long put, should he be paying or should he be receiving the premium? It is correct. Okay, so it's very simple. If you are buying the option, then you're not going to get it for free. So you'll have to pay some premium there. So pay premium. So a long in an option world is always the one who's paying the premium, and short is always the one who is receiving the premium. A very easy trick to kind of conceptualize this, that the reason why someone would short an option, sell an option, is because they want to earn the premium. So if you're short on the call, if you're short on the put, then you are going to receive the premium. Now, this part gets very interesting. So let's work a little bit on the call option first. So let's say there is a call option. Now in call option, typically what we have is, so let me draw a simple piece of agreement. And in this agreement, there would be a price, which we generally denote with capital X. We call this price as the strike price. So let me write down a hypothetical strike price of 100. So the price which is written inside the option, we call this as strike price. Or are you guys aware of any other alternate word for this? Strike price, or we call it as the exercise price. Exercise price. Now strike price is 100. Let's assume that this is the long call. This is a long call, and this is the short call. Now, what is really happening is that short call is taking an obligation here, and that obligation is resulting into a right for the long call. So what long call will do initially, he will pay something to the short call, and that payment is called premium. Correct? So this is happening at the beginning, not at the end of the option. Maybe the option is, let's say, 3-month expiry. So right at the beginning, long call will pay something to the short call. Let's say that the amount of premium is a simple 20. Now what happens is 3 months have passed, and price of that underlying asset, whichever asset on which this derivative is built, that price of that underlying asset is changing. So let's assume a scenario that price of the underlying asset has become 0 rupees. Okay, the underlying asset has become useless. Now listen to this carefully. Let's think from this guy's perspective. He has a right to buy at the price of 100 rupees. But unfortunately for him, price becomes zero. Even more unfortunate, he paid a premium of 20. So can you tell me what is the total amount of loss that this guy has made? Think about it carefully. Something which is worth zero, you're buying for 100, plus you're paying a premium of 20. Plus you're paying a premium of 20. Don't you think it will be 120? Okay, very smart. So you're right. You're right. The loss would be 20. Why? Because this person has only right to buy. This person has only right to buy. He does not have an obligation. He doesn't have to buy. He would simply say, okay, listen, I don't want to buy this from you. That 20 that I paid you 3 months ago, keep it. That's anyways yours. Let's say the spot price has become 70 rupees. Spot price has become 70 rupees. What do you think? Will he buy? Yes or no? Do you think he will buy? No, he wouldn't buy, right? So then what do you think would be the loss here? How much money do you think he'll lose? Because he's not buying Ashi, he would lose the entire amount of money of 20, correct? Because this is the amount of premium that we paid at the beginning. Let us say now the stock price has become 100 rupees. You have a right to buy at 100. Price in the market is also 100. Do you think he will buy? Do you think he will buy? So now you would say it doesn't matter, Utkarsh, whether you buy or don't buy. Anyways, market it's 100 rupees and the strike price is 100 rupees. So it doesn't matter. But unfortunately, because the premium was paid right at the beginning, he is still going to lose the premium. So there's still a loss of 20. I hope you're following this. Now, this is where it gets super exciting. Okay, a lot of people I've seen make mistake here. So I want you to be alert with this. Now the stock price has become 110. Now tell me, will he buy or will he not buy? Should he buy? That means should he exercise or should he not exercise? Okay, the answer is he should buy. And why should he buy? Because this 20 is something that was paid in the past. It was paid 3 months ago. Now that 20 is irrelevant. Now the decision is very simple. The asset is worth 110. You have an option to buy it at 100 rupees. Will you buy? Yes. So how much difference are you getting here? The difference between X and S, when that's positive, we call that as payoff. So how much payoff are you getting here? You're getting 10 rupees. But how much premium did you pay? 20. So now your loss is 10 rupees. Now, had you not exercised the option, had you not purchased, you would have lost entire 20. So now you're exercising not to increase your profits, you're exercising to minimize your losses. That's the thought process here. Now let's scale up a little bit. Let us say now, your lucky scenario, let's say stock price becomes 150. Do you think he will buy? And if yes, what's his profit? What's his profit now? So something that's worth 150, he gets to buy it 100. So he gets a payoff of 50 rupees, but premium is 20 rupees. So therefore profit becomes 30. And finally, can you tell me, as per the regulations by the government in India, for example, SEBI, or in the US SEC, what is the maximum price a stock can go to? What is the upper limit which is given? How much does a stock price, what's the highest price at which stock can go? All right, spot on. There is no such rule, right? I mean, look at the Berkshire Hathaway stock price. It's what, almost $300,000, maybe a little more than that. There is no rule, which means in theory, There is nothing that's stopping the stock from going to 1,000 as well. It can just go to as much as it wants, and which means that profit can also go as much as it wants. So in this case, what do you think would be the profit? Profit would be 900 minus 20. So we will have a profit of 880. And in theory, profit can go unlimited. Got it? Now, let's think from this person's perspective. Okay, the short call fellow. Short call fellow has obligation to sell. Now the problem is, and next 30 seconds are extremely critical, so I want you to be alert. The problem is it's always very difficult to think from short side. Why? Because you never know whether it would be exercised or not, because to exercise or not is decided by the long fellow. So whenever you're supposed to answer from a short perspective, what I recommend is you always think from long perspective and change the sign. Okay. So what does it mean? So ultimately what's happening is in derivatives, there is a very important concept that you need to know, that derivatives work on something called as a zero sum game. Okay. It's a very fancy word, but very simple meaning. What it means is if there are two people here, okay, long and short. So they get into a trade and let's say one guy profits, let's say he has a profit of 20. If long has a profit of 20, where is that profit coming from? That profit is coming because short has lost 20 rupees. It's like casino, right? Let's say you're playing poker, you're sitting on a table, and at the end of the day, you've made good money. You're feeling very happy about your bluffing skills. What you need to realize is the money that you've won is not coming out of thin air. Someone other on the counter has lost the money. So the same thing is happening here. When long makes profit, short is going to lose profit, zero sum game. So once you understand that, then from a short perspective, it's going to become very simple. Obligation to sell. Here long made loss of 20. So if you were short, you made a profit of 20. As simple as that. Just take the same number, but invert the sign. In the same fashion, profit of 20, profit of 20, profit of 10. But now long is making profit. So you have to have a loss of 30. And here in the final scenario, we have a loss. We have a loss that is going to be 880. So that's how you're going to think of the profitability of long and short on a call option. So let's come back to our flow chart and let's do a little bit of fill in the blanks here. So if you're a long call, you have a right to buy. And if you're a short call, you have obligation to sell. So long call, right to buy, short call, obligation to sell. Then what is the maximum profit for a long call? Maximum profit for a long call, tell me how much. In theory, if things go well, how much profit can you make? Unlimited, right? Infinite. There is no limit on that, unlimited. The moment you know that, then what you need to know is that profit of this guy is going to be loss of this fellow. So maximum loss here has to be unlimited. In the same fashion, what do you think is the maximum profit? What do you think is the maximum profit for short call? When someone is taking a short call position, what does he want to earn? He just wants to earn premium. Look at this chart. That when things are going good, look at the blue color, the maximum profit is making is just 20. So maximum profit is premium. And if you know this, then you figure out what is going to be the maximum loss. Okay, now I'm kind of overstepping on FinTree area here, but maximum loss, and that maximum loss is going to be, help me with it, is going to be premium, right? So that's how you want to think of long call and short call. Have you guys understood this? Can you just say yes or no to me on the chat box? Okay. I'm going a little slow initially because I'm assuming that candidates don't have a background, and then slowly we'll build up from here. In case if you feel that you have a question, just put it on the chat box. I'll try to answer it. Let me also check if we're getting any queries on YouTube. So we'll try to answer them as well. If there's anything that's not making sense, just ask. All right, good then. So now that call is clear, let's work on a little bit of put option. So let's create a hypothetical put option scenario. Okay, I've got a couple of questions here. Just 1 minute, I'll get my charging in place. I don't want my battery dying midway through the session. Nice. First question, Sumant has asked that will premium be always 20%? No, Sumant, I just made that number up. That was a random number. It's not necessarily going to be 20%. It can be anything. So premium calculation is slightly more technical. We'll go there slowly as we progress. Second question, how can the maximum loss be premium? So Rajesh, it's a very simple way to think of it. How you want to think is that you buy a call option. If things go well, you exercise your call option, you make money out of it. If things go bad, you just throw off the, you just discard the call option. There is no compulsion for you to exercise. You can exercise only if you want to, which means in the worst case, what you're going to lose, you're going to lose just the premium that you've paid to acquire the option. The buyer is not forced to exercise. The buyer will not necessarily buy, or he will not be forced to buy because he just has a right. Okay, so let's go to put options now. So let's create a hypothetical put option. So let's say we have a put option with an exercise price of 100. Again, we'll create two guys, long put and short put. Long put and short put. Now, who's going to pay premium to whom? Who is going to pay premium to whom? Always, long is going to pay premium to short. Now, how much? So let me take a random number of, let us say 15 here. Okay, so 15. There's no logic to this number. I'm taking it randomly. Now, let us say after 3 months, on the day of expiry, let's say the spot price is, let me again make some random numbers here. Let's say 0, or let us say it is 70, or let's say it is, now this one is interesting, 95. This one is probably 150, and let's say a crazy 1000. Okay, your long call, you have paid 15 rupees. Your long put, you have paid 15 rupees. Let's think from a long put perspective. Now, long put, do you have a right or do you have an obligation? What do you guys think? Long put, does he have a right or obligation? He has a right. And he has a right to do what? Right to buy? Buy? Because long call was right to buy. Long put has to be right to sell, right? You're a seller here. So you have a right to sell. And short put, because this guy has a right to sell, so short put has to have what? A short put has to have obligation to buy. So again, the trick that I give you, we are not going to think from short perspective. It gets very complicated. It's always easier to think from long perspective. All right. So now listen to me carefully. You have a right to sell some asset at a price of 100 rupees. Any asset, doesn't matter. Let's say, let's say a kg of vegetables, maybe potatoes. You have a right to sell them at 100 rupees. In the market, they're worthless. So something that's worth 0, you get to sell it at 100 rupees. Will you sell? Will you sell? Why are you saying no? Why would you not sell? Will you sell? Think about it. Something which is worth 0, will you sell at 100 rupees? Of course, yes. Why not, right? It's something which is worth zero. If you get to sell it at 100 rupees, of course, why not? How much benefit did you get there? You got a payoff of 100. But 3 months ago, you had paid premium of 15. So what's your profit now? So your profit here, I'll probably stick to a yellow color for this. So your profit here is going to be 85, right? Let's think of this scenario. You have a right to sell at 100, price in the market 70. Do you think you would sell? You have a right to sell at 100, price in the market 70. Do you think you would sell? Yes. And then payoff is 30 rupees, but you paid premium of 15. So your profit here becomes 15. Now, this is a tricky scenario. Again, I've seen people making mistakes here. So let's be careful. You have a right to sell at 100, price in the market 95. Listen to me carefully. Will you sell now? Yes or no? The answer is yes. Why? Because forget this 15. This is something that you paid in the past. Now you cannot do anything about it. Today, something which is worth 95, you have an option to sell it at 100. So you have an option to sell it at 100. So what payoff are you going to get? You're going to get a payoff of 5 rupees, correct? But unfortunately, 3 months ago, you paid a premium of 15. So therefore, now you have a loss of 10. Now, had you not sold this, had you not sold it at 90, at 100, you would have had loss of entire 15. So now you're exercising not to make profits. Now you're exercising to minimize your losses, right? That's the thought process here. Okay, how about this situation? Will you sell? How about this situation? Will you sell? No. Clearly, it doesn't make sense. Something which is worth 150, why will I sell for 100? No, I'm not going to sell. So this is loss of entire 15. And finally, will you sell? No. So again, you'll have a loss of entire 15, right? So long call is done. Long put is done, sorry. And once long put is done, then let's think from short put perspective, because with the technique that I gave you, you always have to think from long perspective, and that will do the job for you. So tell me, first scenario, is that a profit or loss? What should I write here? Profit or loss? Loss. How much? How much? 85. That's correct. How about this one? Loss. 15. How about this one? Loss. 10. How about this one? Profit. I made a mistake here. Okay. Profit. Profit 10. Profit 10. Profit 15. Profit 15. So let's do some maximum profit. Let's do some maximum profit, maximum loss scenario. Keep these numbers in mind, and let's see if you can figure out the maximum profit, maximum loss scenario for us. What do you think is the maximum profit of a put option on the long side? Maximum profit of a put option on the long side. Think about it very carefully. Okay. Now in next 10 minutes, I might make a mistake somewhere. It's going to be intentional. I want you to figure out where I make the mistake. The maximum profit for long put is unlimited. The maximum profit for long put is unlimited. No, I made a mistake. You're right. I made a mistake here. The maximum profit is not unlimited. Now, the reason why a lot of people get this wrong is they compare that with long call, because this number is unlimited here. So they think that even long put is unlimited. But see, here is what we need to appreciate, that generally, okay, generally now this has been violated very recently with oil prices, but generally you would not see an asset remaining at a negative price for a very long period of time, right? Generally. Now, this is a theoretical finance, but clearly we've seen that the prices can go below zero. But let's say we have a stock and you don't want stock price going less than zero. Okay, hypothetical. So you have a put option on the stock. Listen to me. That allows you to sell that stock for 100 rupees. Things go wrong, stock is worthless. Then something which is worthless, you sell for 100 rupees. So you get that 100 there, but you paid a premium of 15 at the beginning. So which means your maximum profit is 85 here. It can never go above that in this situation. And if I have to write a formula for this 85, that 85 is going to be strike price minus the premium, 100 minus the 15. So there you go. That's your formula for maximum profit that you can have on a long put. It is not unlimited. It is strike price minus the premium. Do you agree with me now? Does it make sense to you? Okay. And then how about maximum loss? What do you think? Maximum loss. Maximum loss. If things go wrong, what do? You just lose the premium. You say, okay, fine, I paid premium. I'm not going to exercise my option now. Job done. So you just lose the premium. And once you know this, then you can figure out what we have here. So it becomes easier for you to figure out what we have here. So then this profit is premium and this loss is X minus P. And there you go. Your some sort of a schematics of thinking about options is there on your screen. Every time you look at options, this flowchart, if you have this schematic at the back of your mind, this flowchart is going to help you solve questions and understand the situations. Now, next 30 seconds, I'm going to shut up and let you guys process the concept. If you feel that you want to ask anything, put them on the chat box and try to answer. If there's anything that you'd like to ask, feel free to post it on the chat box or raise your hand and I can activate your audio as well. Okay, good. So I'm guessing you guys are fairly comfortable here. Break-even point will go there, Akshay. I'm not hitting the break-even point just yet. Okay, so let's play a nice and interesting game. Here's what we'll do. I would write down a scenario on my screen. Okay. What I want you to do is I want you to evaluate the scenario and then figure out maximum profit or loss, whatever number we're getting there. Put that on the chat box. And then once you've done that, then I will probably enable your audio and you help understand the rest of the audience in terms of what was your thought process for getting the answer. Okay, so we'll probably do 5 or 6 questions like that and we'll see how fast you guys are picking up. Hemant will discuss about that as well. So let me throw the first question at you. Let us have a very simple plain vanilla question, like a sample one, so you'll understand what we're trying to do. So let's assume we have a long call option here. Okay, so we have a long call, and probably this is how I would draw it. I will tell you that strike price of the long call is 100 rupees, and the premium that I paid was 12 rupees. And whatever was the expiry, maybe 2 months, 3 months, anything, on the day of expiry, the spot price. So I'm going to use the notation S for the spot price. What do you mean what do you mean by the spot price? The price of the underlying asset on the day of expiry, which means after 3 months, after 2 months, whenever we expiring. So spot price is 150. And then based on this information, I will ask you to give me two things. So give me what is the payoff of this option on expiry and what is the profit of this option on expiry. Okay, so here's how you're going to give me the answer. You're going to say it's a long call. So you're going to sing your song for the long call. So long call means your song is going to be that it's a long call means I have a right to buy. So I have a right to buy at what price? 100. Price in the market is 150. Will I buy? Yes. So if I buy, what is the amount of benefit that I'm getting? Ignoring the premium, I'm getting the benefit of 50 rupees. So that's my payoff. But few months ago, when I bought the option, I paid a premium of 12 rupees, which means my net profit becomes 38. So the answer to this question is payoff of 50, net profit of 38. That's how we're going to do it. Easy. So what you guys are going to do, the moment I put the question, the moment I put question on the screen, you have to come on to the chat box and answer as quickly as you can. And then the first one. All right, and this was some sort of a sample. The actual quiz is going to be slightly more challenging than this. All right, so let's go to the first question. Sorry, my screen is stuck. Just a minute. Okay. So let's see if you can do this now. Strike price is 150. Premium paid is 35. It's a short call, and spot price on the day of expiry was 115. So what I want you to give me is the amount of payoff, and the amount of profit. Okay, it's going to buffer a little on the for a while because there's some internet problems on my front, but it will improve super fast. So payoff and the profit. I'm not sure if it's buffering on the YouTube, but just be careful there. Type it in the same sequence so that I understand you're doing this right. And if you can do it for panelists and attendees, then everyone knows who the winner is. Okay, let me check what we have here. I told you the question that I'm giving you is not going to be as easy. There are going to be some hidden traps. You should trust your professor when he says that. Somesh, okay, Somesh, I am not sure how you calculated that, but doesn't make sense. Ayush, no. No. I don't see a single one giving right answer so far. Pooja, I would like the complete answer. Avinash, do you want to change the sign of your answer? Just think about it one more time, or you feel that you're correct, Avinash. Okay, so it seems Avinash has got it right. He's probably the first one on our chat box who's got it right. Let me check if everyone on YouTube is getting the answer. Okay, YouTube, it's not working. Nitin probably is closest on YouTube. All right, so Avinash, if you can raise your hand, I'll enable your audio. Please teach us how you solve this. You should be able to speak now. Just unmute yourself.
Hi, am I audible, sir?
Yes, you're right, it seems.
All right. So the selling price, the spot price at the expiry was 115, and this is a call option where the long has an option to buy and has a right to buy. But as the strike price is more than the selling price, he would rather consider expiring this contract, and this position. This sum is on from a short seller's perspective. For the seller, as the option was not exercised, the payoff is zero, and the profit is equivalent to the premium that he received. So it's 35.
Okay. Yeah, I think there's a little bit of internet glitch, but did you guys understand what he said? Let me quickly summarize that to you. So I'll tell you an easy technique through which you could have handled. Thank you very much. We appreciate you helping us out, Avinash. So what I would recommend is that if trust me, that if you learn to think like this, it's going to make your life really easy. Okay, I'm experiencing some internet issue. Yeah, there are some internet issues. Hopefully it will be resolved. Okay, so I'm going to repeat one more time. Is my audio okay now? Has my audio improved? Good. All right. So I'm repeating one more time. Listen to me carefully. If you get a short call question, or if you get any question on short, don't think of short, think of long. That's an easier way to deal with this. Okay. So think from long call perspective and then sing the usual song, right? What's your song? You'd say, I have a right to buy. Long call is all about right to buy. So I have a right to buy at 150 and price in the market is 115. So something which is in the market for 115, will I buy it at 150? No, I will not. So I will not exercise the option. So when you do not exercise the option, the technical term that we use is, we say that option is going to expire out of the money. Okay, so I'll take you there. Just hear it once. That when the answer is no, will I exercise? No, the option is out of the money. So what is the payoff? Payoff is zero, because option is not being exercised. No one is really doing that transaction. But what is the loss to this guy? So this guy paid premium of 35 at the beginning of the contract. So he's going to lose the whole 35. Invert the sign. So zero, take an inverse of it. So zero remains zero, and 35 experiencing difficulties. I'm sorry, guys. I don't know how to fix this. Okay, let's be a little patient. Maybe 5 minutes. How is the audio now? Is it better? Good. Let me repeat one more time. So what I was saying is, I don't want you to think from short call perspective. I want you to think from long call perspective. And then it's way at 150. Okay, I'm so sorry. I don't know what to do with it. Let me check. Let me check my internet. Uh, it can be a little frustrating. I'm completely there with you. Okay, it seems I'm connected. Let's do a quick speed test. I mean, I checked before the session. It was doing all right. Yeah, there is some internet problem, it seems. It's going to take time. Okay. How is my audio now? Do you think it's better? All right. I'm going to make an attempt. It seems this slide is cursed. Let me see if I can get through it. Think from the long side, not from the short side, and say I have a right to buy at 150. Price in the market 115. Will I buy? The answer is clearly no. Why would I buy something at 150 when in the market it's available at 115? So I will not exercise. And when I say I will not exercise, that means the option is out of the money. So what is the payoff? Zero, because no transaction is happening. And then how much money am I losing on the long side? I'm losing 35 because that's what I paid at the beginning of the contract. And once you know this, then what you need to do is come to the short call and just change the sign. So zero remains zero and profit becomes, sorry, a loss becomes a profit of 35. There you go. That's your answer. The payoff is zero and the profit of 35. Got it now? Have you understood this question? Good. Good. Let's do slightly more tricky. Let's see if you can handle this one. This is question number 3 for us now. Strike price, you probably want to use your calculator here. Strike price, let us say 1,000, and premium you paid is 163.22, and it is a short put position, and let us say spot price turns out to be 1133.50. Now, based on this information, you have to figure out what would be the payoff and what would be the profit slash loss to the short put. Start. Make sure you use your calculator. Don't mess up with the decimals. Okay, it seems a lot of people are getting this right this time around. Sarang, you might want to invert your answer. Okay, who's the first one? It looks like Avinash. Avinash again has got this one right, but let's take someone else. Okay, Pooja. Pooja, you've got this right. So let me activate your audio. Pooja, help us understand how was this to be solved. If you can raise your hands, please. Yeah, I think there is an internet problem at my end. That is why it's a problem. Also with respect to Zoom, it has disappeared the participants list from my panel. Okay, Pooja, I don't think I'll be able to activate your audio now. So let me explain this myself. Let me explain this myself. If it's a put option, you tell yourself that I have a right to sell, right? Put option means right to sell. Okay, again, my internet connection is a little frothy here. You might experience a small lag. Just for 10 seconds, it will improve. Is the audio okay? Good, good. So you have a right to sell at a price of 1,000. Price in the market is 1133. So you ask yourself, something which is worth 1133, will I sell it for 1,000? The answer is no, right? So answer is no, which means the option will not be exercised. And if option is not exercised, I give you a term. What do you call it? What type of option it is? I used a term, right? If the option is not exercised, then it is a type of option. We call it as out of the money. Out of the money. We're not going to exercise. It's an out of the money option. So payoff is 0 because we're not going to exercise. There's no transaction. But unfortunately, I paid a premium 63.2. That's your loss. And if okay, if the lag issue happens one more time, I'll probably disconnect and reconnect again. But let's see for one last time if it goes well. Is it okay now? Okay. Okay. Again, my apologies, guys. So payoff is 0, loss is 163.22. And then you say, okay, if that is the case, then short put payoff is going to be 0 and it is going to be a profit, right? It's going to be a profit to the short put, and the amount of profit is going to be equal to premium of 163.22. Now, how many of you got this right? Can you raise your hands, please? How many of you got the answer right? Okay. All right. One last question, and then I'm going to take you to swaps. Let's do one nice pretty question. Let me make it slightly more tricky. Strike price is 700. Premium is 120. It is a short put. It is a short put. And the spot price is 650. So for a short put, I want you to figure out what would be the payoff and what would be the profit slash loss. Start. Remember, it's a short position, not long position. So be careful with your signs. Sarang seems to have got it right. Hemant, you'd have to change your payoff to -50. Again, very simple. Think from long put perspective. That's an easier way to think. Long put. And what's your song when you're long put? 700. Price in the market, how much? 650. Will you sell? something which is worth 650, you get a chance to sell it at 700. Will you sell? Yes or no? Something which is worth 650, you have an option to sell it at higher price. Will you sell? Yes. So if you sell, then you get a positive payoff of 50. But unfortunately, you paid a premium of 120 at the beginning. And since you paid a higher amount of premium, you're going to incur a loss of 70 here. And once you have these two numbers, then you just need to come in here and change the sign. But we will have a profit of 70. That's it. So your answer was payoff of negative 50 and profit of 70. That's how you were supposed to do this. I hope you're getting the hang of what's happening here, and I hope you're enjoying this session. Let me check if my Zoom panel has improved. No, it's still the same. Let me try a few hacks. Video, audio. Let's see if it improves now. Okay, I think it has. No, it is still not improved. All right, so I'm going to take you to swaps now. Hemant, that's correct. So look at what Hemant has said in the chat box. The payoff can be negative for short, but for long, it would always be positive or zero, Hemant. Right? So either it's going to be zero or it's going to be positive from a payoff perspective, not profitability perspective. Okay, all right. So I'm hoping that you guys are at least have an overview of what options are. Anyways, the idea of this class is not to go too much in depth, but just to kind of give you nice flavor of what's going to happen in the derivatives section. And then the next product that we look at is swaps. It's kind of an incredible product. We're going to have fun learning this. So I'm going to, there's going to be a little amount of exaggeration here. So because I want to simplify the concept. Are you guys absorbing, or do you think you need a break? Should I continue? Break, continue, break. Tell me on the chat box what you want. Okay, so here's what I'll do. Those of you who want to take a break, 5 minutes, you can take a break. And those of you who want to hang on, in those 5 minutes, I'll tell you a nice, interesting story. We'll probably discuss some historical situations, events, or anything of that sort. Okay, so let's discuss. This is we'll keep it restricted for 5 minutes. This is 7:15 in my watch. So for 5 minutes, if you want to go and come back, you can do that. And in the meanwhile, if you want to listen to the story, just say hang on. Okay, so what story should I tell you now? Let me think of it. Okay. There are plenty of stories. Let me tell you the story of Tulip Mania today. Has anyone heard of Tulip Mania in the past? Okay. All right. So here's how the story goes. A long time back, a Turkish emperor, he decided to visit some royal family in Europe. So when he goes there, he feels that I should carry some sort of a gift with me. So what he does is he carries a tulip bulb with him, a tulip bulb, so that with the help of that bulb they'll be able to grow a plant. So that royal family is very happy to receive that gift, and what they do is they take that tulip bulb and they build a nice, beautiful tulip garden in front of their house. Now, the other royal families in Europe, when they visit this particular royal family, they look at that beautiful tulip garden, and they feel that maybe even we should have a garden like this. So what they do is they take the some bulbs from this royal family. They buy those bulbs, a little bit of bulbs from this royal family, and then have a tulip garden in front of their house. So very soon, this all the royal families in Europe, they want to have this tulip garden in front of their house, and it kind of becomes a sign of royalty. So if you're from a royal family, you want to have a tulip garden there. So slowly, the other rich people in that area, they feel that even we should have a tulip garden, even we should have tulip plants. So those rich people, they also start buying the tulip bulbs. And then very soon, everyone, with some money is buying tulip bulbs. Why? Because they realize that the price of tulip bulbs has been increasing exponentially in the last few months, right? So you're buying because the price of tulip bulb is increasing. You're buying because the price of tulip bulb is continuously spiking up in the market. So now a lot of traders get excited. And what traders feel is they feel that, they look at, now I'm exaggerating here, but they must have seen that, oh, this is the graph of tulip prices. And maybe what we should do is we should also keep on buy. We should probably buy now and sell them in 2 or 3 months after and make money out of it. And then the prices of tulip is increasing to a level where the price of one tulip bulb, the price of one tulip bulb, one plant, okay, so one plant is equivalent to maybe around 15 hectares of land. One plant is equal to 15 hectares of land. That means the prices go to some really crazy level. And then one fine day, suddenly some sort of a sanity comes into market, and then people ask, why are we buying tulips at such a expensive price? Why, like, is there a logic why tulips are so expensive? And suddenly the markets crash, and this is probably the first bubble, an asset price bubble known in the history of mankind. And therefore you'd hear a lot of financial analysts and the fund managers on television saying that what you're experiencing today is tulip mania, right? What you're experiencing today is that people are buying some asset just because they feel that the asset prices are continuously going up without really putting any rationale into it. So maybe 2008 real estate was some sort of a tulip mania. And prior to that, the 2001 or 2000.com, 2000, 2001.com bubble. So .com bubble, that was a tulip mania. And there is a very interesting theory that pops out of tulip mania. That interesting theory is called the greater fool theory. Okay, so what's a greater fool theory? What's a greater fool theory? So a greater fool theory is that I am buying this asset, and I'm buying this asset, I'm buying a stock maybe. I'm buying a stock at a really expensive valuation. For example, some of the FMCG stocks in India today, right? If you look at the likes of maybe Nestle's and HUL, they look like very expensive on the face of them. So I'm buying this stock and it's very expensive, and I'm a fool to buy it at this price. I'm a fool that I'm buying it at such a high price. But very soon I will find a greater fool who would buy it from me even at higher price. And then this greater fool theory works for a while, where people keep on buying at higher prices. And again, it leads to a bubble, and then someday bubble crashes and prices revert back to normal. All right, so that's our story for the day. We have exceeded our limit. I hope you've enjoyed. Source of this story, I'm currently reading a book called Adaptive Markets. So there's a reference to this. And prior to this, I read about this in a book called Ascent of Money by Ferguson. That's also a brilliant book. If you guys get a chance, go through it. It starts with, and it kind of is a beautiful book because it is a beautiful combination of history and finance together. So it talks about why certain cities in Latin America have done good for themselves versus certain cities haven't. So get your hands on it if you get a chance. I'll repeat the name of the book. It's called Ascent of Money. Ascent of Money by Ferguson. That's the first book. And the second book, it's a recent read. I haven't finished it yet. It's called Adaptive Markets. Okay. So let's get back to the business. And we were going to discuss on the jobs here. So let's say we have two couples here. So this is the first guy, and this is the so since it's a couple, a traditional couple of sorts, we'll have to give them some name. So we'll call them the Play Safe family. The Play Safe family. Okay. And here's the second couple. So the second couple is okay, my apologies, but I think that's the only drawing skills that I have. And this is Bring It On family. Bring It On family. Okay, now what these guys are doing is that Play Safe family, they're kind of very risk averse people. They don't like taking risks. They want to play safe. So what those guys do is they put all their money into a very safe, government bond or a fixed deposit type of investment. So let's say they have an investment of 100,000. They have an investment of 100,000, and it is into a fixed income product which is earning them annual return, a fixed income product, a fixed deposit type of product which is earning them an annual return of, let us say, 5%. Whereas Bring It On family are more of a risk loving category. So they have made an investment. They have made an investment of the same amount, $100,000. But let's say they have invested their money into some of the risky stocks. Okay, so give me a name of a couple of risky stocks that has caught your fancy recently. Some of the stocks that you feel are risky. India, non-India, doesn't matter, any geography. Okay, I'll pick up an example from the past, but this example kind of works well. So they have put in their money into a non-existent airline today called Kingfisher Airlines. Are you guys aware of it? I'm sure you've heard of Kingfisher. Have you? In some of the other contexts, I'm sure you've heard of Kingfisher. You probably have heard of the calendar as well. So Kingfisher Airlines, it's a company that went bankrupt and couldn't pay most of its bankers as well. Okay. Now here is the conversation that's happening with the Mrs. or Miss Playsafe to the Mr. Playsafe. She says she's a little disappointed today, right? So they're at some sort of a party, and she's disappointed because she looks at the jazzy Bring It On family, and she complains to Mr. Playsafe. She says, "I'm not very happy with how you manage finances. Look at the Bring It On family. When you look at them, they look rich. It seems like they're doing good for themselves. why do you always invest into, fixed deposits? Why can't we do what Bring It On family is doing, and we invest into Kingfisher Airline type of stocks? So now the guy is thinking, he says, okay, fine, let me think about it. And then the same type of conversation is happening on Bring It On family. So the Mrs. Bring It On, she says, I don't like, how you're managing our money. Look at what all stress has done to us. Uh, it would have been so nice if you had invested similar to play safes. They invest into fixed deposit. They don't take risk. Their life is sorted. It means both the families are kind of unhappy with themselves. So there is a middleman here. There's a middleman who's in the party, like a guy who's listening to all this conversation, and he proposes them an idea. And the idea is, he says that what you guys need to do is you need to swap. What you guys need to do is you need to swap. Uh, don't get too creative here. What I meant by swap is you need to enter into a swap derivative. And what kind of swap derivative? So very simple. For next 3 years, you guys keep invested in whatever you're invested in. But for the next 3 years, whatever money PlaySafe family will earn on their investment, they will just give it to you. So for next 3 years, whatever money PlaySafe family earns on their investment, they will just give it to you. And for the next 3 years, whatever money PlaySafe family earns on their investment, they will give it to you. So it is an exchange of return on different instruments or different investments. Okay, so let's say now one part of the puzzle is kind of very easy for us, because we know that the PlaySafe family every year is going to pay 5,000. So that's not going to change. That's 5,000 is constant. PlaySafe family every year is going to pay 5,000. And Bring It On family every year will pay depending on how the stock behaves, which is an uncertain variable here. So maybe some year the stock will do good, some year the stock will not do good. So let's say the first year the stock actually did really good and it gave you a return of, let's say, 12,000. So then Bring It On family will have to pay them 12,000 rupees here. So what it essentially means, it means I will pay you 5, you pay me 12. We don't have to do that. What we can simply do is we can do the netting. We can net the two amount and tell me how much would be the netted amount. The netted amount would be 7,000, right? So you just pay me that 7,000, job done. Next year, Kingfisher Airlines made only 3,000. So I will pay you 5, you pay me 3. Now we can again net the amount. And then the netted amount is that PlaySafe family will have to pay 2,000. And finally, the most interesting year, last year, Kingfisher Airlines actually made a loss, and it made a loss of, let's say 1,000. So I will pay you, and listen to me very carefully now, it gets a little tricky. I will pay you 5,000. You pay me negative 1,000. I'm going to give you 5,000. You give me negative 1,000. What it basically means is I will have to give you how much? I will have to give you an amount of, help me with it. Tell me how much. I will have to give you an amount of 6,000 rupees. And that's it. At the end of year 3, the transaction is closed. So this is a highly simplified, exaggerated version of how swap transactions really work. This 100,000 that you see here, this is referred to as the notional principal. Notional principal. In most of the swap transactions, the notional principal is not exchanged, which means you don't really go and give that 100,000 to anyone. It doesn't work. You just use that notional principal for calculation purposes. And this 5%, which is kind of a fixed rate, we call this as the price of the swap. Okay, now why is it called price? That's a bit technical. You'd understand that the day when we learn a more in-depth swap class. But right now, just know the fixed rate which is used in the swap, that's referred to as the price of the swap. And that's typically how swap transactions work. Okay, so with this now, my agenda more or less is over. and fortunately for us, it's over right on time. So now next 20-30 minutes, I'll be answering all your queries, either with the session or with the FRM. But I would like to start with queries on SOAP. I generally get 2 or 3 common questions here. So if you guys would like to raise any questions, just raise your hand. Oh, my attendee list has come back, so that's a good news. So if you'd like to speak, you can raise your hands now, and I'll enable your audio, or you just type in into the chat box. Okay, so Shubha wants me to repeat the last part. So here's how you think of it, Shubha. Whatever profit you make, you give it to me, and whatever profit I make, I give it to you. So that means your profit belongs to me, and your loss also belongs to me. So think from the playset family. They were supposed to give 5,000 and they were supposed to receive profit. But in that year, instead of making profit, there was a loss. So they are supposed to accept the loss. Therefore, they have to pay 5,000 plus they have to pay the 1,000 loss as well. So that's how they'll have to make a total payment of 6,000. Good. Yes. Any other questions? Any doubts you guys have? Anything you'd like to ask? Let's see if we have any hand raises here. I have one hand raised from Hemant. Hemant, you good to speak?
So just one thing, from options perspective, it's always good to be to be in long position, right? Because your losses are limited and your profits are always like on a higher side. So I wanted to understand, like, anyone, why that person would like to be in the short position, because he knows that even if he's in a short put case or he's in a short call perspective, his losses are always unlimited.
Okay, that's a good question. Thank you for asking that, Hemant. Let me quickly try and explain that to you. For those of you who did not understand, I'll summarize this question to you. Question Hemant asked us. He said that when you did this this option flowchart, in that option flowchart, you told us that long has unlimited profit, long call, but his losses are limited to premium, whereas short call has unlimited losses and limited profit. So why would someone ever sell an option? And this is probably how I used to think in my very early days of option trading. And that early days, by the way, lasted for mighty 1.5 year before I realized how stupid I was. So I'll tell you how I started trading option. I read a sentence in one book. That sentence was that when you buy call option, you make unlimited profit, but you lose only premium. I thought, okay, this is what I want to do for the rest of my life. I asked my father for some capital. I said, please, loan me some money. And I set up a demat account with my friend who was a broker, and I started buying options left and right. And I was so stupid, but I was lucky that time. I was making money. So what happens in long option if things go wrong, you make a lot of money, but the time, which is an essential element in trading options, the time in case of long option is against you. What do I mean by that? You make money in a long call when the underlying asset goes up. It goes up by a significant amount, and it goes up within the time period, right? Typically, the expiry of the option. So time is kind of your enemy when you're on the long side of the option. But when you're on the short side of the option, you're settling for smaller profit. You're not going to make a lot of profit, but the time is your friend. And generally, what I've learned after few years of option trading, there is better money to be made on the short side compared to long side. Most of the marquee traders that I've come across, most of the institutions that I've come across, those guys are proficient in selling the option on the writing options. So I'm not saying you don't make money on the long. You can make money if things go well, but generally short side provides you good returns if if uh, if your risk management is kind of proper there. Okay, so I know that my answer might not sound very convincing at this moment, but just wait out a little bit. Let us go to option Greeks. Let's learn the concept of theta. And once you understand why long options will have negative thetas and short options will have positive theta, automatically this will make sense to you. Okay. Avinash, okay, that's a crazy request. Put in some query, I'll be happy to answer. Anyone else would like to speak? Mohit, all right, Mohit, go ahead.
So one doubt, I have in terms of options which we have discussed. So like if we talk about the live option chain, what we see on NSE website. So the only when I say when I'm in a long position with respect to call, but only the premium varies, right? Not the 100 minus 85, whatever the calculation we do with respect to spot price matters. Here only the premium
Mhm.
varies, and we are only just playing with the premium. So
Right,
is that
you're right.
correct?
Yes, that's correct. So there are two parts to it. One is when you buy a call option. Uh, okay, so let me give you an example. See, so let's assume that this is a call option in my hand, and I bought it on NSE site, whatever site, doesn't matter, any exchange. Is my audio clear to all of you? Can you hear me properly?
Yeah, it is clear. Yeah.
Okay, good. So I buy it for, let's say I buy it for 20, 30, 50 rupees, whatever. I paid 50 rupees, I bought this option. Now there are two ways in which I'm going to make money. One is, let's say my expiry is 3 months from now. That means this option has a life of 3 months. Now I bought it for 50 rupees and tomorrow morning I got up and to my surprise, I saw that this was trading at a price of 60 rupees. Right? So what I can do is I can simply sell it off for 60. So I will give that piece of paper to someone else and I'll take 60 rupees. I bought it for 50. I'm very happy. Or I will wait out for 3 months. And at the end of the third month, when the option is going to expire, at that time, I can exercise the option. I can pay whatever is the strike price and can receive the underlying asset. So there are two ways in which you can settle an option. Either you can exercise the option or you can simply sell it in the market. So most of the time, 99% of the time, we're not really doing deliveries. We're not really settling it. We're just selling it off in the market. Okay, so what you're saying is correct, but that's just partially correct because settlement can happen. And
Okay.
what we learned today, in terms of I have a right to buy, will I buy or will I not buy, that will determine how much this paper will be worth on the last day. Which means even if I decide to sell my option, how do I figure out what's the price of that piece of paper? So that would be determined based on the algorithm that we learned or the logic that we learned today.
Okay, but
Is it clear now?
yeah, it's
Okay, yeah,
clear.
go ahead,
But
go ahead.
yeah, it's thanks for an explanation. But like in a real life, real life scenario when we do the trading, so then it's all about the premium, right? Even if my strike price, let's say if 100 rupees, and now after 3 months my strike price is 120, then uh, it's just about the premium which varies, and we play on the basis of premium, not like 120 minus 100 or 100 minus 120. So I'm just trying to clarifying my
Yes,
confusion here. Like concept wise I
yes,
understood,
yes.
like, but it's all about the premium in real life scenarios, right?
Yes, that's correct. It's all about the premium and what determines the premium.
Okay, underlying strike price, right? Yeah,
Strike price and strike. That's one of the important
correct.
variable. Spot price and strike price, and then few other volatility RFR type of variables. So
Yeah,
it'll all
got it.
come to you.
Mhm. Yeah,
Uh,
yeah.
when I do a slightly more advanced class on option, that day I would be showing you the option chain and everything that you referred to. In fact, you would find some of my videos on YouTube as well, where I've explained how do you trade on options and all of that stuff. So you can also look them up.
Sure, thanks sir. Okay.
Thank you. Okay. Anyone else would like to ask anything? You can raise your hands. Okay. Shahrukh wants to ask anything. Shahrukh, we good to go.
Yeah, hello, Utkarsh.
Hi, Shahrukh.
Am I audible?
Yes, you are. Go ahead.
Yeah, actually, my question was in terms of swaps, like if one party is not satisfied with the terms that they are having, like the place a family, so why don't they just square up the position and they enter into a new position, like from flexible
Okay, yeah.
rates to the fixed rate?
Got it. Got it. That's a great question. So what Shahrukh asked, let me summarize that for you. He said, why such big tomfoolery and circus in this swap example? Why not just cut down on your fixed deposit, or why not just sell your Kingfisher stock? Invest that money into a fixed deposit. Why make it so complicated? And that's a great question. See, number one, swap is not a retail product. It's an institution product. I did this example just to make it a little easier for us to understand at the beginning. Number two, that let's think of a more realistic example. Okay, so maybe I'll give you a more realistic example. Let us say a very large hedge fund manager. Hedge fund manager or hedge fund. Hedge fund is it's a large institution that invests on behalf of some wealthy investors. Okay, so you can think of them very loosely speaking, think of them as mutual fund for a kind of a mutual fund for super rich category of people. So very large hedge fund investor has bought in, let's say, hypothetical 8% stake into, let us say, HDFC Bank, a private sector, largest private sector bank in the country. Now, what he feels is he feels that for next 1 year, the bank will not do good because of the whole COVID situation, because of the delinquencies, because of delays in payment of interest. But after that, the stock will do excellent. So what options does he have? Number one, he can sell now as you proposed, and he can buy in 1 year, correct? Or option number two, he can enter into a swap where he does not need to sell. What he simply need to do is he simply need to enter into a 1 year swap transaction with that amount, and whatever returns that he earns on HDFC, whether it's profit or loss doesn't matter. Whatever returns come to him, just give it to someone else. Just push it on someone else. If it's profit, give it to someone else. If it's loss, take that money from them. And then in return, you receive a simple return, maybe 5%, 6%. And after 1 year, the swap is anyways over. And then you simply make money because the stock price is going to go up. So what's the problem with sell now? There are multiple problems. Number one, most important problem is if you sell now in such large quantity, there is going to be a very massive transaction cost. Now, you might argue and say that, Utkarsh, we have brokers like Zerodha now, low-cost brokers. There is almost negligible transaction cost. But what I want you to appreciate is transaction costs are two types. I don't want to get too technical here, but there is an explicit transaction cost and also implicit transaction cost. So explicit is the brokerage and all of that. But in implicit, there is a very big transaction cost. We typically call this as an impact cost. So what's an impact cost? Look at this. This guy holds 8% shares of that particular bank. When he decides to sell 8%, there's going to be so much of supply of stock in the market that because of that supply, slowly price will start selling, price will start going down. So maybe the first share, he will sell it at 1100 rupees, but by the time he ends up selling his last share, he might end up at 700 or 800 rupees, right? Because of that large supply. So therefore, a lot of institutions, instead of simply buying and selling, they will prefer to mitigate the exposure just by entering into a swap transaction. And this is just one of the multiple uses that we can have of a swap. This is again a very simplified example. There could also be more complex scenario. Does it answer your question, Shahrukh?
Yes, Utkarsh.
Okay. Do you want to counter me or ask anything?
No.
Okay. All right. Thank you. All right, guys. We still have time if any one of you would like to ask queries. Let's take Hemant. Hemant, yours is done, right? Hemant? Do you
Yes,
wanna
sir.
ask a
I'm
question?
done. I'm already done, sir.
Okay. Okay. All right. Who else do we have? We have Raj here. Raj, you should be able to speak now. Uh, I think he's having audio difficulties. Kiran, yes, this will be uploaded on YouTube, so you can see this later on as well. The whole session will be available on YouTube at a later stage. Okay. All right. So it seems queries are drying up. By the way, all the audience on YouTube, let me do my customary uh, remark. This is my colleagues keep on reminding me of this. Please like the video, please comment, and please subscribe to the channel. That helps us a long way. We're trying to hit some subscriber target in the next couple of months. So in case if you like the video, please help us on that front. Okay, so my mandatory part is done now. Let me take some questions. Let me take some questions on the chat box. Would 500 hours of dedicated study time for working professional would be enough to clear the exam? Definitely yes. 500 hours is a really comfortable time to pass FRM Part 1, assuming it's a quality 500 hours. And if you optimize your time, I'm sure you'll definitely be able to pass. Then how do you get the GARP notes from? So Ankita, you can get GARP notes on the GARP website. And then I have seen some people are selling them on Amazon. You can sell them on some people are buying them from some pirated bookstores in Mumbai. I think Mahakali, Lakshmi. If you just Google for them, so you figure out how you want to buy and which copy you want to buy, and then you can get it from there. Ayush, what is the best course for starting in the stock market? You don't really need a course, Ayush. It depending on what stage of learning curve you're in. But there's plenty of free YouTube material. If you watch my last two CFA level 1 videos, I'm doing a 3-video series for CFA level 1 where we're discussing about stock markets in depth. So 2 videos are already on YouTube. You just have to search for FinTree CFA classes. You would find those videos quite useful to get you started on markets. Okay, do we need to pay for FRM registration fee for buying GARP notes? I think yes, Mohit. But if you buy them on Amazon, then you can avoid all of that. Mohit has a question. He's asking, what about the session I missed on 24th and I've joined at 7 p.m. where I can see the class video? So Mohit, today's class and the previous class, both of them are available on YouTube. You just have to go on FinTree channel. You can watch them directly. The next class would not be. So it's just the first 2 classes that we're broadcasting for FRM on YouTube. Okay, so a couple of important things that I want you to do before I make the closing remarks. Number one is it's an important to-do list. So for next 5 minutes, just don't put anything on the chat box and listen to me carefully. Number one, please get added to the broadcast list this week. Last week, I waited to create the list because throughout the week I kept on receiving new contacts. So I'm planning to do it on Thursday this week. So Thursday is when I'll be broadcasting the first message to your batch. So please make sure you get added. Now you have to get added to 2 separate lists. One is run by my colleagues, the admin team at FinTree, and one is run by me. So get in touch with those guys. They'll help you with the instructions in terms of how to get added. And I would be shooting the first communication to you on Thursday evening this week. All the communication that we would be doing with you in terms of schedules, in terms of study material, class notes, everything is going to happen through WhatsApp broadcast lists. So it's important that you're added in those lists. Then number 2 is you have to buy the Texas calculator. Now, Texas calculators that you want to buy, but make sure you buy the professional version, not the student version. If you've not already purchased, okay, professional is slightly more expensive. It will cost you about 4,000 Indian rupees if you go on the Indian Amazon, or just look it up elsewhere. But make sure you buy professional version that has some added features which we would be using extensively. If you already have a student version, that's okay. But if you don't, then get the professional version. Number 3, if your FRM account is activated at FinTree, then what I want you to do is go to a subject called financial markets and products. Financial markets and products. So that's where I'm going to start your curriculum from. I would be throwing in some theory from book one once in a while, but we're going to start with financial markets and products. Now, within financial markets and products, there is a topic called banks. That's the first topic in the FMP subject. I want you to start watching videos of it. Okay, so this week your target is that you have to finish the banks video, which is discussing financial markets and products. I would be doing some basic session for next 2 more weeks before I start with the technical FRM part 1 curriculum. And then once I do that, it would be nice if you guys are already prepared on a few topics so that we can enjoy the classes better. Okay, so that's roughly the game plan from my side. I have not prepared your calendar yet, so I don't have a schedule ready. I'm still working on it. It generally takes us a few weeks to prepare because we're trying to go a little more granular there. So you'll have to wait probably for 1 more week before you get your hands on the calendar. So that's something that's due from my side. Calendar regarding your classes, and I have not prepared your weekly test schedule yet. So that is still due. So that we will do probably in 1 or 2 weeks from now. So I'll let you know once it is ready. Okay, so that's it from my side. I've covered or spoken everything that I wanted to, and we still have time. I can see you guys have queries. So if you want to ask anything, just post them on the chat box or speak up, whatever ways is good enough. Will there be a live session on how to use calculator? Yes. I will be taking 1 session on calculator. Of course, I'll have to do that. But I would strongly recommend all of you to go and look up the level 0 videos. I would strongly recommend you to go and look up the level 0 videos, because we will just get 2 hours in a live class, and level 0 videos, especially on calculator, are roughly 10 hours. So I have done a lot of practice questions there, and it's important that your basics are clear before you get started with more advanced topic. Shweta on YouTube is asking what is banks. So Shweta, it's a reading in the FRM part 1, and the video is available inside the FinTree learning management system on fintreeindia.com. So in order to get access, you probably have to sign up and get your account activated with the help of admin team. So if you've already signed up, just get in touch with the team, get your account activated, go to financial markets and products, and go and watch the first video there. It's called banks. Is it possible to get weekly recommendations between 2 weekly sessions? So I generally communicate, Ashutosh, with candidates on Mondays or Tuesdays, but these are still early days. We've not started the batch in full swing yet. So first 2-3 weeks, I'll be going nice and easy on you guys. And once we are in the whole scheme of things, then you'd hear from me more frequently. But yeah, you can typically expect one communication a week from me on WhatsApp broadcast list. I'm a working professional. I have to work even on Saturdays, whether I can, whether if any class done on Saturdays will be recorded from, or classes will be on weekdays also. Yes, Mohit. So again, our standard timing is Sundays this time, right? This is the late evening time on India. Now, if I take classes on any other time apart from this standard time, for example, if I take classes on, let's say, Saturday, or I might take some classes on weekdays as well, but very few, not many of them. Then what I will do is I will record those classes, and for a week, those classes would be put under your account on the FinTree learning management system. So you will have one entire week to finish that particular class. So I understand that many of you might not be able to attend the sessions on Saturdays or weekdays. So we'll take care of it on that front. Which books are good for technical analysis? Sumant, I am someone who's completely anti-technical. I am not in favor of technical analysis. Neither do I understand that very well. So I'm not probably the best person to advise you on that. Varun is asking for FRM Part 1. Will this year physical classes will take place at Bangalore? So Varun, I think just 15 days before the whole COVID situation, the whole lockdown situation came in, we actually got ourselves a very nice, beautiful office in Bangalore. I mean, we shifted to a new office in Bangalore. We're at Kormangla, and we definitely plan to have live classes there. But at this moment, there's a lot of uncertainty with the whole lockdown and COVID situation. So we would wait out at least for a month to see how things are, and probably after that we'll take a call. But our intention is affirmative, but we will have to wait and watch based on the situation. Okay, then again, you guys have a. I think let me put this to rest. Let me put things to rest. There is a lot of questions that I get on GARP versus Schwezzers, right? GARP versus Schwezzers. I keep on receiving this all the time. Schwezzers is, by the way, Kaplan material. So which one do we need to use? Should we be using GARP material or Kaplan material? Now, your friends must have recommended you to use Kaplan because that's what they might have used in the past, and it might have worked for them. And one of the reasons why Kaplan or GARP or Kaplan or Schwezer was so popular all these years is because the FRM GARP Institute created a lot of confusion by bringing in 10 different types of material. They had their core material, and then they had their handbook and all of that. Now, what I believe is from 2020 onwards, GARP has published this very sweet 4 books, right? Each book size is roughly 300 pages. And if you're reading this book, you're actually reading from the core material from which your questions are going to be set. One of the problems that I find with Schwezzers is it comes at the cost of oversimplification. Okay, so you might find some references within my videos where I've referred to Schwezer here and there, but I'm planning to discard most of those videos and re-record the new ones, primarily relying on the GARP material because that's what we believe that, like at FinTree, that's our game plan. That's how we are planning to rank up our passing percentage significantly in the next 2 seasons. We're relying excessively on the GARP material, practicing the questions that the GARP has provided, and increasing the level of difficulty of the questions that we will putting on the test. So if you have to choose between the two, I would encourage you to get access to the GARP material. Don't swing too much towards Schwezer. Schwezers are easier to read, but the language on the exam is going to be challenging, right? So you know, what's the fun in learning something that's very easy but not useful? You might as well spend some extra efforts and get acquainted with the language used in the GARP material. Okay, so please get access to GARP. Do not rely on shortcuts. They do not work at FRM Part 1. And what I'm going to promise you is that if you attend these sessions together, I'm going to break them down as much as possible, take a difficult concept, break it down into smaller pieces. And after the session, if you go and read through GARP material, you'd realize that they're easy. They're not as difficult. We will also try to eliminate most of the formulas. So there are plenty of formulas in FRM Part 1. I'm not saying that I'll be able to conceptualize all of them. There are some formulas which are very cryptic, there's nothing we can do. But at least 80 to 90% of the formulas, we would convert them into logic so that you would not have to memorize them. So that would make your life easy, and hopefully that kind of answers your question. So if you have to choose, please get GARP notes. Don't use Schweizer's. Or if you feel that, okay, you can afford to get both, then get GARP and Schweizer's both. Study primarily from GARP and use Schweizer just as a reference material or a practice material once in a while. But if I had to write the exams again, and which I did, by the way, recently in 2018, here's what I'll do. I'll use the GARP material, plus I will use, of course, now you guys are doing videos on top of that. I did not do videos. I got a little bored when I was watching my own videos. But do the videos, do the GARP material, and then use internet extensively. That's I think the real trick here. Okay, so there is so much of high quality material available on internet, but use internet more like a dictionary. You know, what do I mean by this? Don't go on internet and start looking for everything. Attend the class, read the GARP book, and then after reading that, let's say there is one concept called open interest that you're not able to understand. Go on YouTube, type in open interest, you'll find 10 different videos. Go and watch them, right? And then do a vertical and horizontal learning. So if you're learning open interest, then learn how open interest is calculated on open interest is calculated for options, open interest is calculated for futures, learn everything. Then also learn how open interest is different from volume. That means learn everything that's there to learn about the concept. And then that's how slowly you build your knowledge base. Okay, now some of the tools that you need to prepare, like some of the tools that I use. There is a very brilliant software that I use extensively. I've been using this for last 2 years. It's called Liquid Text. Liquid Text. It's an app. All these years, it was exclusive only to iPad, but recently they have launched this for Windows as well. Has anyone heard of this, or is anyone using Liquid Text? Okay. It seems I've been promoting them quite a bit. I have no vested interest whatsoever, but I'm a big fan. It's an incredible app. It's a PDF reading app. One of the things it does, let me see if I can give you a quick demo on it. So I'm going to launch my iPad on my screen. Okay. All right, this is my iPad. This, by the way, was your chat box. Okay, so this is my Liquid Text app, and let me open some random books here. Okay, so recently I read a book called Understanding Michael Porter. It's more of a management book. Now let's say I'm reading the book, and while reading the book, there's one particular paragraph which I feel is very important. So what I can do is, let me pull out my Apple Pencil here. And what I can do is I can just, select this area and I can say, create an excerpt out of it. So what it does is, on the right hand side, it opens up a panel and it saves that particular excerpt for you. And then if you feel that, okay, I am on page number 4 right now, I want to see what's there on page number 7 and compare that. So you can pinch it and you can have, page number 7 or page number 13, 14. And one really cool thing what I like is I can connect this page number 5 with page number 13 like this. And then next time when I'm on this page, if I click on this icon, it takes me there, right? And this is just one of the many features which are available on this particular app. So I'll request, if you guys, and I think on Windows, the trial version is available free of cost. So you can consider getting access to this app. So this is something I use extensively. Then there is another app that I use, which is called CardFlow. So let me show you the CardFlow Plus. So this is an app. What this app does is, for example, now sometime back, I was studying this concept called FRTB. Some of you might already be working on it. So when I'm studying something, I make graphical, colorful notes for myself. So this app works like some sort of a flashcard. Okay, so what I do is I would probably write down question on one side and answer on the other side. So somewhat on these lines. So here I have not written questions, but I have plenty of cards like this. And then whenever I put these cards into my mobile phone and whenever I get a chance, let's say these are Basel 3 notes that I prepared. So whenever I get a chance, I keep on revising with the help of these flashcards. Okay, so you can also consider getting yourself an app like this. I'm not sure on what platforms it's available, but I'll write down the name. So you don't have to necessarily get exactly the same app, but you get the idea. You get the idea of what you want to do. So you can get some sort of a flashcards app. The one that I use is called CardFlow Plus. So that works like a charm. The third technique that I use is I make voice memos. Uh, So now I've stopped traveling, but prior to this whole COVID situation, I was doing a lot of Pune, Mumbai. So there was a lot of traveling that was happening. So what I do is these days our mobile phones have this capability where we can speak something and record. And every time I would find something interesting or something that I want to remember, something that I want to think about at a later stage, I would just create a quick 30-second, 1 minute audio note for myself, and I put that in my mobile phone. And then whenever I'm driving, I would play all these voice memos one after another, and that's a very smart way of revising. For example, now let's say today we did something on swaps, and what I told you on swaps is I told you that the notional principal is not exchanged. Do you remember that this 100,000 was not exchanged? So what you can do is at the end of the class, just open up your mobile phone and say to yourself that in most of the swaps, notional principal is not exchanged. That's it, 10 seconds. And then next time you're driving or next time you're cooking, you're in the kitchen, you're cleaning something, you get free time, you feel like you can listen to something, just turn on these voice memos and it will automatically help you revise. So you want to learn to optimize your time smartly, and some of these tools will come in very handy. And of course, the fourth thing that you would find a lot of value in is use the FinTree juice notes. Uh, I'm kind of a big enthusiast of better ways of learning, better ways of reading material, and all the years of experience that we had, me and my team in education and all of it, we've put that into juice notes. So I'll probably show you a sample so you understand what I'm saying. So if I go to juice notes, 2020. So let me show you probably book one juice notes. So typically when you're reading some text, it's generally verbose, it's full of stuff that you don't need. What we've done is we've taken the same material which is available in the car, but we put them in a flowchart type of fashion. Okay, so some of the numerical concepts you'd find them even more useful. Let me show you, let's say book 3. Let's look at swaps topic. So this is swaps. Now, this is what we've done. We've converted all of them to infographics and easy to understand material with the help of large font colors. So you're going to find this juice notes extremely helpful for your revision. And what happens is when you read them again and again and again, after a while, you build some sort of a pictorial memory, right? You just look at them and you remember, oh, this was a blue color flowchart. And that's the whole idea. And that's the reason why we've used so many colors with them. So that's what you can do. And of course, I'll give you a lot of tips as we progress in the course. So hopefully I was able to answer most of your queries. Hopefully I was able to answer most of your queries. So that's it from my side. In case if there's anything that I couldn't answer, just leave it on the YouTube comments and I would try and answer that later on next week. So thank you very much. You guys have a nice week. Let's connect again next Sunday, same time.